Next question. XYZ Ltd is an export-oriented business house in Mumbai. The company invoices in the customer's currency. Its receipt of $1 lakh is due on 1st of September. Market information as at 1st of June is given as under. Exchange rates have been provided to us. Spot exchange rate is given. 1 month forward is given. And 3 months forward is given. Currency future is given. Dollar per rupee. June futures is given. And September futures is given. Lot size is provided to us rupees 4,72,000. Initial margin that you have to pay when you enter into the futures contract is 10,000 if it is June month contract, and it is 15,000 if it is September month futures contract. Rate of interest in India is 7.5% and 8%, and these rate of interest are always required to be understood as per annum rate of interest. On 1st of September, spot exchange rate is, US dollar per rupee is 0.02133, and the currency futures rate is 0.02134. Again dollar per rupee, of course. Comment which of the following methods would be most advantageous for XYZ Ltd. Using forward contract, using currency futures, and no hedging. That is what the alternatives. It may be assumed that the variation in margin would be settled on the maturity of the futures contract. This is not required to be given, it is always understood. I give you a simple explanation for the margin like this. Suppose say it is a library. So initially what the library management was doing, that say it was giving books to students with an instruction that say if at all there is any damage, then you have to pay the damages. Let us say that there are a few books which have come back with certain damages. So the management of the library gave notice to those students that you have to pay an amount of 50 rupees, you have to pay an amount of 100 rupees, you have to pay 200 rupees, like that. However, most of the students were not paying at all. So library management took a decision from the next year like this, that you have to pay a deposit of rupees 1,000 with us. If at all there is any damage for the books that you have taken, we will recover the damage of that book from this deposit, and we will give you the remaining amount back at the end of the year. If at all you want to renew the membership, then you have to keep the deposit with us. Otherwise, if at all you want to terminate your membership, then this amount will be given back to you after deducting the damages. So if at all there is no damage for any of the book that I have taken, then full amount will be given back to me. So the same is the case which is provided over here. Then in case of the futures contract, you have to pay this amount of the margin. Why margin is supposed to be paid? Because if at all you are incurring a loss and you don't pay the loss, then we will recover that loss from the margin amount that you have paid. And if at all you pay loss to us, then in that case that margin will be given back to you. And if it is profit, then of course that profit will be given to you, and along with that the margin will also be returned to you. This is what we understand. I request all of you just to go through the question. Don't write answer. Just go through the question. So let us answer the question. A question answer. Forward contract. In the write down, on 1st of June, XYZ Ltd, in bracket I am writing Indian company, will enter into forward contract for 1st of September for sell of dollar and purchase of rupees. Sell of $1 lakh and purchase of rupees. We understand that's the July, August and September. So we have to focus on the 3 months forward exchange rate. It is 0.2127. So it is dollar or rupee. So $0.02127 for every 1 rupee. What is the amount of consideration? 1 lakh. $1 lakh is equal to this amount of rupees. So 1 lakh into 1 does not make a sense. Divided by 0.02127. So kindly use a calculator. 1 lakh divided by 0.02127. So that comes to 47 lakh 1,457.45. This is the amount of the rupees that you will receive if at all the forward contract is entered upon. That is answer of the A alternative. Now instead of B, I am doing C because that is a small working. No hedging. So you can see that on 1st of September, the spot rate of dollar per rupee is 0.02122. So C, in that no hedging. Of course friends, we understand that if at all you do not hedge, then in that case you are required to convert the dollar into rupees at expected spot exchange rate. So in that case, spot transaction on 1st of September for sell of dollar and purchase of rupees. Sell $1 lakh and this is the amount of the rupees that you will get. So dollar and rupees, $0.02133 is equal to 1 rupee. So for $1 lakh, this is the amount of rupees. So 1 lakh into 1 divided by 0.02133. That comes to 46 lakhs 88,232.54. This is the amount of the rupees in case of no hedging. B alternative is, that is the important one, currency futures. I request you to post your answer for the currency futures, say in the chat box, that what would be the answer. You may give answer ignoring the margin information which is provided to us, because the margin information is new in this question. So ignoring that, say you just give your answer that what is the amount receivable by the Indian company if at all it is entering into currency futures. Now friends, we can do this answer by this process. Let us have a discussion of the same. I just want to have a discussion before we write anything. Once again, we are required to focus on the 3 months futures contract. The futures contract which is expiring before 1st of April is of no use to us. Kindly use your calculator. 0.02118. This is the exchange rate into 4,72,000. That is the lot size. Product of both of them is $9,996.96. That is the lot size. Okay. Now what is the amount of the consideration? 1 lakh. So please use your calculator once again. 1 lakh upon 996.96. That comes to 10.03. 10.0030. So of course we understand that say 10, 11, but we'll enter into 10 contracts and not 11 contracts because the answer is very near to 10. So step number 1 is entering into 10 contracts. So write down heading currency futures. In that write down step number 1. In that write down on 1st of June for September, XYZ will enter into futures contract for September. Full stop. Futures contract will be sell of dollar and purchase of rupees. With paragraph write down number of futures contracts. In that contract and amount. Dear students, in my raw explanation, I took dollar currency. Now I am taking rupee currency for dictating answer. To explain you, let's say you can write answer by taking either dollar currency as base or you can take rupee currency as base. Taking either of them as base is acceptable. You enter into one contract, it means that the transaction is entered upon for rupees 4,72,000. And the amount for which the futures contract is supposed to be entered upon is $1 lakh divided by the futures contract for the month of September. For that the rate is 0.02118. So this is the number of contracts which are required to be entered upon. So kindly use a calculator once again. It is 1 lakh divided by 0.02118 into 1, that does not make a sense, divided by 4,72,000. With that, say you'll be able to get say the same answer. Let us check that. 1 lakh into 1 does not make a sense, divided by 0.02118. So that answer divided by 4,72,000, and I'm getting the same answer, absolutely no change. So 10.00304 contracts. So of course we enter into 10 contracts. If at all somebody is doing answer with 11 contracts is acceptable, it is not like that it is not acceptable. However, I do not suggest that say to take 11 in this kind of situation. So this is the step number 1. Step number 2. Dear students, as we have understood that on 1st of September, there are 2 transactions which are required to be entered upon by XYZ Ltd. One is square off of the original futures contract, and the second is entering into the new future, the second is entering into the spot transaction for conversion of the dollar into rupees. So in step number 2, write an answer. square of original futures contract comma by entering into reverse of original futures contract. Okay. So we understand that so the original contract sell of dollar and purchase of rupees. The reverse will be sell of rupees and purchase of dollar. This is what we understand is the original, and this is what the contract now. Okay. So it is 4,72,000 rupees is the lot size. So 4,72,000 into 10. That is the number of contracts. So of course it is 47,20,000. This is again 47,20,000. 0.02118. That was the rate at which the contract was entered upon initially. That is on 1st of June for say September. 47,20,000 into 0.02118. So 99,969.6. 99,969.6. This is the sell dollar. Now purchase dollar is 47,20,000 into the exchange rate prevailing on 1st of September for the month of September. And the currency futures rate is provided thus 0.02134. So here it is 0.02134. $0.02134. So it is 1,724.8. And difference of that is what we understand is a profit. So the amount of the profit is $755.20. Importantly, friends, you can see this time that say we are having the profit in the foreign currency. So step number 3, in that calculation of amount to be received on 1st of September. Now importantly, friends, spot transaction will be entered upon for sell of dollar and purchase of rupees. You can very well understand the original futures contract which was entered upon, because we were supposed to receive this consideration, that amount is received on 1st of September. So there is no need to carry forward that futures contract. So we are squared off it. There is a profit of 755.2 plus 1 lakh. So the amount of the dollar that you will have is 1,755.20 dollar, and for that, so this is the amount that you are going to receive. If at all there would be a loss, then in that case that loss would be deducted from 1 lakh. That is the reason say I had dictated a note to you. In that say the word adjustment I had dictated to you. So what is the spot exchange rate on 1st of September? It is say 0.02133. So we understand that so the dollar and rupees 0.02133 dollar is equal to 1 rupee. You have an amount of 1,755.20 dollar, which is equal to this amount of rupees. So in that case, the answer is 1,00,000 $755.20 into 1 divided by 0.02133. So the final answer comes to 47,23,638.07. This is what's the answer that we have, ignoring a new point which we have the margin. So now let us understand how to incorporate the margin. So calculation of net amount, again in rupees term. So amount received on 1st of September minus interest on margin. Remember that the margin is, as I told you, is a simple deposit that you have paid. So this amount of the deposit has a carrying cost to you. So what will happen? 4723 638.07 minus interest on margin. You can see that if at all you enter into the September futures contract, then in that case you have to pay margin of 15,000. So over here it is 15,000 is required to be paid for one contract. You have entered into how many contracts? You have entered into 10 contracts. So 15,000 into 10, you must have paid that 1,50,000, and that amount is remaining blocked for 3 months. That is from 1st of June to 1st of September. Into rate of interest, which is provided to us in the example as 8%. And of course this rate of interest is required to be considered to be the per annum. So 0.08 into 3 divided by 12. That is the way we are supposed to say make the computation of the interest on premium. Interest on the margin. So it is 4723 638.07 minus 1,50,000 into 8% into 0.25. That comes to an amount of 3,000. So it comes to rupees 4720 638.07. Now this is required to be compared with the earlier two alternatives, and we are going to select an alternative which is going to give us the maximum amount. So let us have a small summary of the currency futures. Step number 1, on 1st of June for the month of September, the futures contract is entered upon. You cannot enter into the futures contract for June itself. Why? Because 1st of September is falling after, that is the June futures. Now this contract will be entered upon taking into account the amount of the consideration, that is 1 lakh, taking into account the exchange rate 0.02118, and taking into account the lot size 4,72,000. So in the first step we get the answer as 10.003. So we will be having the 10 contracts to be entered upon. Second, on 1st of June there are two transactions in which we enter upon. One is the spot transaction and another is the cancellation of the futures contract. First of all, we do the cancellation of the futures contract. Original rate was 0.02118. The revised one is 0.02134. That is on 1st of September for the month of September. Simply the sale means the payment and purchase means the receipt. And always whatever the lot size, that is 4,72,000, for that we will have the sale and purchase of the same amount because it is required to be squared off. This amount of the profit is in dollar currency. In step number 3, what we are going to do, whatever $1 lakh that we have received, to that this profit is added, and in case of the loss, it would have been deducted. And then whatever the gross amount or net amount is required to be converted at the spot exchange rate on 1st of September. The reason for that is very simple. This amount of the profit will be given to you on 1st of September only, or this amount of the loss will be recovered from you on 1st of September only. That is the reason, so on 1st of September the spot rate would be applicable for this conversion. So with that, say we make the calculation, and finally we'll have the computation of the net amount. In that also the things are very simple. As far as the margin is concerned, it is only a kind of security deposit. It is never a cost. It is never a cost at any point of time. Remember it, whether it is a chapter of the derivative or it is forex or any other. It is only that, say, a security deposit is given, which will be given back to you if at all, say you that is a discharge your obligations. Over here there is a profit, so there is no obligation as such. The carrying cost, because the amount is blocked for a time period of 3 months, so you will be having, so the interest to be paid for a time period of 3 months. This is the way we make the computation of answer, and finally we are required to take a decision. And the decision, A is forward contract, B is futures contract, and the C is no hedging. This three is required to be compared. This is the amount in rupees term, and this amount of the profit or loss, the alternative in which we are going to receive the highest amount is going to be selected. So friends, in case of forward contract, it is 47,01,457.45. In case of no hedging, 46,88,232.54. And say in case of the futures contract, it is 47,20,638.07. And from this three, we are going to select an alternative which is going to give the highest amount. So over here we understand, say we are going to select the futures contract. That is what we understand. Write down a small note for the answer. In case of futures contract, comma, as it is exchange traded, comma, so there is a fixed lot size and a fixed date of maturity. Full stop. It is not like forward or money market hedge, in which amount payable or receivable in domestic currency is fixed. Full stop. With paragraph write down. In addition to that, importantly, on 1st of September, XYZ Ltd is required to enter into following contracts. In the trade down, square of original futures contract and the second is in spot transaction conversion of foreign currency in domestic currency. Dear students, in my opinion, this is the most important thing that a student is required to understand. So this is the way, so we can enter into the futures contract for the purpose of hedging.